We've talked a little bit about how gold is priced over $100 higher in China. And I don't care what the conventional answers are by the talking heads. I believe they're doing it for a reason. They want to see at $100, how much gold can they siphon off from the West? How about 200? How about 300? Keep raising the price of gold and silver higher and higher and higher and watch the arbitrage that takes place. I do believe that you will see either Abu Dhabi, the United Arab Emirates, or Shanghai Gold Exchange in China take over for the COMEX and the LBMA at some point as they continue to lose legitimacy.
In the ever-changing currents of global financial markets, the words of Andy Schectman ring true: the markets are more powerful than any central bank. Schectman also points out an emerging trend in international relations. Some countries pursue mutually beneficial objectives rather than allowing the West to dictate terms. This perspective reflects a changing dynamic in global politics and economics. On the other side of the world, Prime Minister Datuk Seri Anwar Ibrahim has announced discussions about using a gold-backed currency in Malaysia. These deliberations will occur during an upcoming December meeting focusing on Islamic economics and finance. This move showcases Malaysia's active exploration of the concept of the gold dinar as a reserve currency, indicating a growing interest in precious metals as a financial safeguard. In global trade, President Xi Jinping has made an intriguing commitment to Gulf Arab leaders. China seeks to purchase oil and gas using the yuan, a move that not only supports Beijing's ambition to promote its currency on the international stage, but also has the potential to weaken the US dollar's stranglehold on world trade. The surge in China's local gold prices and Chinese banks distancing themselves from Western gold price auctions suggests a significant shift in the precious metals market. Andy Schectman's belief that China may assume a more prominent role in setting gold and silver prices underscores the changing dynamics of the global financial system, as Western entities like the COMEX and LBMA face challenges to their historical dominance. Before diving into Andy Schectman's interview, subscribe to our channel and give this video a big thumbs up.
You are beginning to see countries like China go in and industrialize places like Africa and South America in a cooperative manner to help bring these to the marketplace and not at the sole benefit of the West, but a cooperative benefit of both parties. We see Malaysia actively exploring the gold dinar as a potential new reserve currency for Malaysia. The Prime Minister of Malaysia just came out a few days ago and said if we can get between only 5 and 6% with Islamic countries using the dinar, it would be a positive start as it provides strength and reduces the dependency on the US dollar little by little by little by little by little. This is what we are seeing. We're seeing all of these countries strike deals in their local currencies. They were all tasked, their finance ministers, going back to the drawing board, coming back in 24 with ideas on a common settlement currency. It will come. We talked a lot about Brazil and China doing this deal in corn a few months ago, where Brazil is the second largest exporter of corn in the world, signed a deal with China to sell them whatever they sell them, they'll accept payment in yuan, and China would accept payment in real. And now it's gone past corn. The export sales of U.S. soybeans have decreased by over 40% compared to the same period last year because the largest importer, which is China, has turned to Brazil and are buying Brazilian soybeans instead of U.S. soybeans, little by little by little by little. China came out, there was a report in Reuters last week, actually 2 days ago, October 22nd, wants to deepen oil and gas cooperation with Gulf countries and seek potential for cooperation in the new energy vehicle industry, such as power batteries and smart charging piles. So, look, all of the rare earth minerals, most of them are found in the Eurasian continent. President Widodo of Indonesia, who's an OPEC country, said, yeah, we need to create an OPEC-style cartel for rare earth metals as well. Not thinking this out very well. You're seeing de-dollarization little by little by little. The Shanghai Petroleum and Natural Gas Exchange just the other day settled its first cross-border transaction in digital yuan. So they've done several transactions for oil settlement and natural gas settlement domestically, but this is the first one they did overseas. Now, they didn't tell us who the counterparty was, but that counterparty accepted digital yuan. It's the first cross-party deal they have ever done, which is interesting. And while we're talking about China, before we go on or I answer any questions that you have up until this point, a very interesting thing is happening. We've talked a little bit about how gold is priced over $100 higher in China. And I don't care what the conventional answers are by the talking heads. I believe they're doing it for a reason. They want to see at $100, how much gold can they siphon off from the West? How about 200? How about 300? Keep raising the price of gold and silver higher and higher and higher and watch the arbitrage that takes place. I do believe that you will see either Abu Dhabi, the United Arab Emirates, or Shanghai Gold Exchange in China take over for the COMEX and the LBMA at some point as they continue to lose legitimacy. And that's going to happen. Now, it's interesting. The three biggest Chinese banks that have been involved in setting and participating in the LBMA gold price auctions, the ICBC, the Bank of Communications, and the Bank of China, have all disappeared. They've just disappeared from the price setting of the LBMA, and without any real acknowledgement of anyone talking about it, or where did they go? Why did they just stop? I wonder, did they realize that the West is rigging the price and they just want to be out of it? And they can point to that. And that's why they're slowly raising the price in China.
Andy's assessment points to a complex economic dilemma, the potential consequences of central banks' actions to control inflation through interest rate hikes. While these measures are intended to rein in rising prices, they also carry the risk of further economic strain, adding pressure to the financial system. The United States is grappling with its first significant inflation crisis in decades, with the Federal Reserve resorting to aggressive interest rate hikes to counter it. This turbulent economic environment has left both Main Street and Wall Street uncertain, affecting consumers and leaving investors in a perpetual state of hesitation. However, some analysts have a growing sentiment that the Federal Reserve's influence on the economy may not be as dominant as it once was. Fed Chair Jerome Powell's recent remarks at the Economic Club of New York suggest a shift in the central bank's role in controlling the inflation narrative. Joe Bruswalis, our SMUS chief economist, noted Powell's implication that the Fed might no longer hold the reins on the inflation story. Let's get back to the interview.
We've talked a lot about in all of our conversations together, one of the things that we've talked about quite often is the acceleration of events around us. And I think that's very important to acknowledge that, it used to be just a drip and a drab, and now it seems everywhere we look, leaks are springing. And as it relates to geopolitical tensions, the Federal Reserve came out on Friday and said that the escalation of these tensions pose a threat to the global financial system amid higher risks of inflation and slower growth. Well, that's going to happen. You're going to see oil prices rise. You're going to see higher inflation as a result of it. You'll see the central banks do what they can to stem inflation by raising rates more, which hurts the economy more, which hurts the banks more. They are in a doom loop. And the higher the rates go, 5% on the 10-year Treasury for the first time in 16 years, the higher the rates go, the greater the strain on the system. They also said that the potential for broad adverse spillover, they use these grandiose adjectives to explain their positions. You have to read them 2 or 3 times. Broad adverse spillovers for the global markets in the event that the Middle East conflict and the war in the Ukraine intensify or stresses emerge elsewhere. Well, in other words, they're saying there's going to be problems, spillover. There will be systemic problems. And Powell himself said that the geopolitical tensions pose important risks to the global economic activity and carry highly uncertain implications, and warned of increased volatility and the likelihood of a significant economic slowdown as credit dries up. This is, you hear a lot of people talking about the money supply drying up, and it is. You're seeing M2 drop at a level that we've never seen before. We're seeing the repo market being drained of its liquidity as all of this money is in search of yield, most of it going directly to the Treasury. Places like treasurydirect.gov, we see tons of money leaving, the regional banks going into the money markets, and much of the money that it was in the reverse repo market, a lot of it being the money market funds, are now leaving the repo market facility altogether and going right to the Treasury, which that repo market facility is the lifeblood of many corporations who need liquidity. And it's drying up like we saw in 2019. And so we are going to experience, I believe, great stresses. But instead, what we are seeing, I think, is the realization that the markets are more powerful than any central bank. And the fact that we see massive dumping of the long end of the curve on the 10-year and the 30-year Treasury, where the rates just aren't high enough to attract anybody. And so what you are seeing as those bonds are sold off, rates rise higher on the back end of the curve instead of the Fed lowering the front end. This is very, very bad. You have rising front end and a rising back end. You have a bond market that is losing credibility. You have a bond market and an economy that is losing liquidity. It's not as deep as it once was thought to be. And so I think when we talk about what could happen, yeah, I think we're going to see a lot of problems as it pertains to rates, to the banking system, to the economy. And the spillover, as Powell wants to call it, I think is something that is not to be taken very lightly. Quite to the contrary. I think we'll see rates much, much, much higher. And I think it's just beginning.
In this era of shifting economic dynamics and evolving central bank policies, are we witnessing a transformation in the traditional role of central banks in controlling inflation and steering the economy? How might this growing landscape impact individuals, investors, and the broader financial system in the future? If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.